world. As you can see in the bottom left, they have brands like Monopoly, Transformers, My Little Pony, and Nerf. Currently, they're sitting at just under a $9 billion market cap, and in 2021 they generated a revenue of $6.42 billion. The dividend yield is 4.32%. 58% of the revenue comes from North America, 27% of the revenue is generated in Europe, 8% in Asia Pacific, and 7% in South America. From this revenue, 53% are franchise brands, 22% are partnered brands, 17% are from Hasbro Gaming, and 8% are emerging brands. To give a final valuation to the company, we'll be using a margin of safety at the end of our valuation. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease based on the ratios we're going to look at in just a moment. To determine how much the margin of safety will increase or decrease, we'll be using a scale. When there's 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% reduction. If we're using 3 colors, bright red will mean a 5% increase, orange will mean a no change, and bright green will mean a 5% deduction. The first 2 ratios that we're going to look at are the EBIT growth and the margin growth. As you can see, the EBIT has grown from 500 million in 2013 to close to 1 billion in 2021. During this period, the average growth in EBIT was 7.9%, meaning no change in our margin of safety. As you can see, the margin has stayed the same for the most part, having a peak in 2016 but flattening down going to 2021. The average growth in margin was still 1.2%, meaning a 5% deduction in our margin of safety. The next 2 ratios are the dividend growth and the payout ratio. Dividend growth has gone from $1.72 per share annually in 2014 to $2.72 a share annually in 2021. The average dividend growth during this period was 6.9%, meaning no change in our margin of safety. The payout ratio is sitting at a very high 93.2%, meaning that further increases in dividends are very unlikely since they're already spending most of their earnings on dividends. This means a 5% increase in our margin of safety. The final ratios are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of our debts. In this case, it's just over 2.5 years, meaning a 263% debt to EBITDA ratio, which is in our orange section of our scale, meaning no change in the margin of safety. The return on invested capital is 8.45%, meaning once again no change in our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Hasbro. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. During this period, the average growth in cash flow was just under 10%. Since we're calculating the lifetime expected growth of the cash flows, I've gone with 50% of the average growth, which is just under 5%. Using this percentage, we can determine the future free cash flow of Hasbro and determine the terminal valuation using a perpetual growth rate of 3% and a discount rate of 9%. Summing up all of the present value of the free cash flows, we get a sum of free cash flow of just under $13 billion. Then to get our equity value, we just have to add the cash and equivalents and subtract the total debt. Out of this, we get a $9.7 billion equity value. Finally, to get our discounted cash flow price per share, we just have to divide it by the amount of shares outstanding, which is 130 million shares. Out of this, we get a discounted cash flow price per share of just under $75. With the current price of $64.86, we get an upside of $9.90, which is just over 15% upside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts from 4 years ago to the current date. During this period, the average growth was only 2.72%. This is because they didn't increase their dividends for 3 consecutive years. To give them a fair valuation, I've imported the expected growth rate that we have calculated earlier using the dividend increases from around 10 years. In this case, that's 3.5%. In this case, we'll also be using a discount rate of 8.5%. Doing this, we get a dividend discount model price per share of just under $58. With the current price of $64.86, here we get a downside of $6.90, which is just under 11% downside. The last valuation model we'll be using is the multiple valuation. By looking at companies similar to Hasbro, looking at their stock price and their earnings per share, we can determine an average PE ratio in the industry that Hasbro operates in. In this case, this average PE ratio is 15.37. To get our fair value, we have to multiply it by the earnings per share that Hasbro generates. In this case, we get a fair value of $46.58. With the current price of once again $64.86, here the downside is $18.28, which is a 28.18% downside. Let's go look at the final valuation overview of Hasbro next. Looking at our final overview, we have imported the discounted cash flow price per share, the discounted dividend price per share, and the multiple valuation price per share. Out of this, we get an average price per share of $59.77. In this case, not using a margin of safety, we would get a downside of 7.85%. But we have calculated our margin of safety prior to this, using a standard margin of safety of 25%, deducting 5% from the margin growth, and adding 5% for the payout ratio. Then we get a fair value of $44.83. And with the current price of $64.86, in this case we get a downside that's almost 31%. If there's any companies you would want to see on this channel next, please let me know in the comments. Thanks for watching.